Thank you for that. Oh, shoot, I missed the first part.
That's all
Let's
good.
start over. Start over.
Start over.
Hi, I'm Mark Ambard. I'm CCIM. I'll be your moderator.
Yeah.
Thank you, everyone, for joining us. By the way, we like questions. Please put them into chat. Someone will pick it up if it's, if we can do something with it, or give you some intelligent answer. Because commercial roundtable today, and most everything commercial, in my opinion, since I am one, starts with the agent who gets the ball rolling and finds out what's going in the market, who's getting the pricing and establishing a lot of that with the customer. So I'm going to start today with our industrial agent, Jay, and ask him what we got going. What's the market doing? Anything you like, rents, prices, occupancy, homeless people in your garage. What's going on in your world?
Thanks, Mark.
Oh, and by the way, I'll be going to office and retail after you, so they might want to be prepared to say what's going on in their life.
So of the product disciplines and the product types, I think industrial is faring the best right now. There are segments and sectors in the industrial market that aren't doing so hot. And then there's sectors and segments in the industrial market that are doing really well. I do have a mixture of both. Kind of anecdotal situation here though. Got a call on Monday from a large industrial user that also has 15 retail locations. And in the midst of this COVID crisis has decided that they're going to close down about 6 retail locations and actually haven't been able to make rent in the last 2 months. So the situation in the industrial market is real. We are seeing that happen case by case, not probably as rampant as we would see in the retail sector, but definitely some signs are showing up. However, on other sides, we do have pockets that are doing really good. We've signed a bunch of new leases in the last 30 days. We are still seeing some movement and activity out there. We've actually closed a couple of deals, but these were pre-COVID transactions that were already in the pipe, but we were able to get them closed and whatnot. So definitely an interesting time that's happening in the marketplace right now.
What are rents doing? New people come in. New tenants, are they paying their rents? I mean, you get a new tenant right now, you get first in security, then they decide not to pay rent and there's a rent moratorium. What do you do?
And we'll have to cross that bridge. So far, so good. I mean, the rents we were getting are market rates. I did 2 leases at $1.40 a foot triple net. And I did a lease just recently at $1.20 triple net. And these are new leases. So
How big were those spaces, Jay?
Huh?
How big were those spaces?
Anywhere between 2,000 to 10,000 feet. So
Right
not
on.
bad. Yeah, we got some good deals on the table that we were able to close. Construction sector, like I said, is still doing really strong right now. There's still ongoing work. They were part of the essential group that did not get shut down, so they're still active out there. So it's interesting.
All right.
Hey Jay, on any of those deals you closed recently, were they acquisitions?
I did. I closed 4 acquisitions in the last 30 days.
And were values affected during the closing and the appraisal? Like, was there COVID language where you thought it was going to be a $2 million value and it was really 1.6, 1.7?
Not quite. We haven't stretched that yet. We haven't gotten to that point. Although 2 of the deals were revisited post final loan approval. Yep. So they were revisited during that period. But we were luckily that we were able to get it closed. Yeah.
Sean, your comments on the market?
Sure. So
And be bold. We're trying to create a round table here. I want to get discussion. Make a comment. Say something.
Will do. I bifurcate my time between institutional investments and office and healthcare leasing. And so let me talk about the leasing side first, which that's probably keeping me a lot more busy right now. We had a massive uprise in occupancy over the past year in just in the office sector, which drove up some pricing pretty significantly. We went from about, call it 16, 17 vacancy, all the way down to about 9.5% to 10.5% vacancy in the office sector, depending on which report you're looking at. Which was all attributed to one of the office towers downtown, 1132 Bishop, taking out of the office pool and put it into the residential for lease properties. That had just a sweeping effect downtown, and pricing started to go up. We were really kind of pressed for some of the tenant rep that I do to really try to close those deals ahead of that cycle. That has now changed. I think the sentiment, and right now we're still a little early in the process, so the sentiment is that there is going to be some price adjustment. We are going to see probably some increase in vacancy as well, but that is going to be probably over a little bit of time, not just immediately people vanishing. The office sector has not fared as well as the industrial sector, but is still not as in bad shape as some of the retail sectors where it just are completely closed. Downtown, I've heard numbers at about 15 to 20% of the businesses are still in operation. The rest are all working from home. We're seeing some of the workouts now where landlords aren't giving necessarily. So I pulled out my playbook from 2008, 2009, when the last down cycle happened. And immediately the tenants just started asking for rent relief, and landlords started acquiescing and giving that. This time, we're not seeing that quite right off the bat. We're actually seeing landlords pushing back and saying, you have all these stimulus packages out, the PPP and the CARE Act, go apply for those. Show us that you're applying for those, and we'll talk about it. Now we're starting to get into the situation where those who did not get the first round of PPP or weren't applicable are now waiting for the second round, possibly not getting that either. And now we're starting to have to renegotiate leases. But unfortunately, landlords aren't giving out a free lunch. So they're starting to rip open the leases, negotiate term, negotiate some rent structures to try to get for some alleviation right now in place. And so we're seeing that. Healthcare side has still been fairly strong. There's been a bifurcation of the healthcare sector as well. The hospitals and so forth are still very busy, as everyone can imagine, but a lot of the non-essential healthcare, physical therapy, psychological, all of those types where you have to meet in person still are not being met. And so some of those healthcare sectors are starting to see some signs of fragility. Rents, we're starting to see possibly starting to renegotiate a little bit. We were on an uprise where the average rents were at about $1.40 to $1.60 in downtown Class A high rise. We're starting to see that possibly coming down. It really depends on how long we're going to be in this period of stay at home.
Sean, I got a question. This is
Sure.
coming from the perspective of someone who wisely signed a 7-year office lease 3 weeks before COVID. Are you starting to see any stay-at-home orders like language where if tenants trying to bring language in that says, if all of a sudden stay-at-home orders come, we don't have to pay rent, anything like that?
We're not at that stage yet. All the deals that we're dealing with right now are either renewals that have been working in place or tenants trying to restructure existing leases. So new deals are far and few between on the lease side. Everybody trying to stay in place or do maybe extend if their lease is coming due, extending it for a short period, maybe 6 months to a year.
Lyon?
Yeah, I just wanted to add to Sean's comment regarding when he was talking about landlords, talking about the PPP program and providing some additional funds for folks coming in. We did have that situation currently. We're working on a multi-tenanted retail center on Oahu, when during the appraisal assignment, the property owner was working out rent relief with a number of the tenants. And then during the conversation, was happily informed all of us that, hey, our tenant just informed us that they did receive their PPP check and they are going to be paying April and May's rent. So it was good to hear that story and to see that the program was doing what it was intended to do, and landlords are seeing that response from their tenants, that they're like getting the money and they're paying their rent. And that was definitely a relief to us also looking at the deal. So
Let me fit Ted in here. I had a question for Matt.
I'll answer that And a second, I have one more question for Sean. Sean,
Okay, repeat Ted's question because no one knows what it is when you get to it.
Okay, I will. Sean, in regards to the lease negotiations, you're saying you're getting quite a few trying negotiating the leases. I would say it's, or at least my assumption is, it's kind of the food chain. Food chain is, if the lender is giving forgiveness on loans, then the landlord should, or hopefully should, be passing those forgivenesses on to the tenants. Are you seeing more forgiveness in leases if they are getting forgiveness from their lenders? It's not always happening, so I'd be interested in that.
A lot of landlords aren't sharing that information. The landlords that I do represent have not yet received any kind of reprieve on their debt service. So they're working through hoping that the tenants are going to start being able to pay vis-a-vis the PPP program. But yeah, hopefully they will start passing those through, but they're not sharing that information yet.
Got it. In regards to Ted's question, it's in the chat. So he's asking, California is supposedly going to force, or tenants can force lower apartment rents from landlords. Is this a real possibility? I don't see this yet. I'm actually seeing the complete opposite, and it's a real life instance where my brother lives in a 340 unit apartment complex in Placentia, California. His lease is coming due in June. He's paying, call it $2,200 a month for a 2-bedroom, and they're trying to increase his rent to $2,600. So I'm seeing rents increase just as normal, if not more. I don't see them getting away with that yet. One, a lot of tenants are just not paying rent, and you can't evict them right now. So I think you'll see landlords try to increase the rents and then settle upon, either them paying the same rent, but I don't see it going lower yet.
Roger, what's the retail thing doing? We'll get back to you in a second, Ryan. Let's listen to the
Good
Lions
morning.
before the Lion.
Thank you. I'm going to share my screen. Olivia, I'm not sure if it can work, but let's try it. Save for hospitality, the retail industry is the hardest hit so far that we can see. I don't know if you can see my slide or not. Retail generates $1.2 trillion nationally. Those are the leading sectors. Retailers and malls have had recent troubles before COVID. Shopping center vacancies were increasing. Online sales are increasing. Retail bankruptcies were at a record in 2018. So there was already trouble. Many feel that this pandemic is really going to push a lot of people over the edge, so to speak, retailers and shopping centers. So far, we've seen the best performing industries are grocers, obviously general merchandise, hardware stores. I would say hard goods versus the hardest hit industries are soft goods, which are predominantly apparel, which leads to the department stores, many of whom I think are on the brink right now. And then other places that we're seen as entertainment, however, suffer from people gathering together, which is not good anymore, movie theaters and gyms. And then I thought I'd give an example of a brand familiar to everyone, just to kind of encapsulate the real trouble in retailer here, and that's the Gap. They just put this statement out. They've got 3,300 stores. They stopped paying rent on all their stores. That's $115 million a month. They furloughed their workers, suspended stock repurchase, deferred dividends, reduced expenditures by $300 million, cut executive pay. Then they tapped their entire $500 million revolving credit facility. And guess what? It's not enough. That's basically $1 billion decision a couple of weeks ago, and it's not enough. I don't know, that paints a pretty grim picture. Then if we look at the 50th state, really the big nut thing is the visitor arrivals are down. And I think this slide, that's your visitor industry, folks. I don't think you need to say anything beyond that. I don't think any of us ever envisioned that. Take a ride or a jog or a bike ride through Waikiki right now, and it's unprecedented. What we're seeing right now, long-term impact of critical factors are yet to be determined. Unemployment rate, obviously up. Vacancy rates are going to increase. Market rents are going to decrease. I'm not a market guru for telling you that. That's obviously, but we just don't know right now the long-term impacts. And no one's talking about long-term impacts. Never before has the industry been so focused on the here and now. I mean, it's basically April rent. And that's what landlords are talking about, and retailers are talking about. How do I keep my store open if there are? And really, we're getting into non-economic terms in the leases are under more scrutiny than ever. The first thing we learned is that business interruption insurance only comes into play if your location is physically damaged. So business interruption insurance is not going to cover anything. Co-tenancy, force majeure, continuous operation, these are all coming into play. Is this an act of God? Is it not? The major tenants closed. Do I have to pay my rent? Continuous operation says you're supposed to be open at all times and you close your store. Are you in default of your lease because of that? You know, these are the issues that are in play right now that people are talking about.
You know, I've done Roger, I've probably done 3,000 leases. And, you know, I knew one day force majeure would finally come to fore. Because I tell you, that thing is the most obscure provision in every lease I've ever done. Try to explain it to someone.
Exactly.
Sorry to interrupt, but it's just amazing that it was force majeure of all those leases. That was the one.
I don't like this winners and losers because, but I just titled it that way. But clearly the grocers and the hard goods and retailers with a strong online presence prior to coronavirus are the ones doing better. And then again, the losers really, we may see the end of the department store here. Will Nordstrom be the only one standing when it's all over? Soft goods, again, are in.
Marcus.
Well, they just filed, right? So
that's what I meant. It won't be Neiman Marcus.
Okay.
Nordstrom, maybe.
And then some of the what ifs, we saw a report last week that said the number of malls may drop to 50%. So what's going to be the repurpose of that real estate? And will the remaining 50% of malls have very high occupancy? That's a possibility. What are restaurants going to do to re-image? And one of the silver linings that I see for the local and smaller retailer is having that advantage of being nimble and being more in touch with your local consumer. And they may really have an opportunity here coming out of this to offer service and goodwill. And maybe we're headed back to more of a Main Street retail environment.
That'd be nice. Lyon, you had something to say?
It's the thought has escaped me at the moment. So.
Okay, no problem.
No,
Just didn't want to forget you.
It was back to apartment landlords in the comment that in California they were seeing some possibly increases. We did hear on a couple of appraisal assignments we have active at American Savings Bank on multi-family properties that some landlords that were surveyed actually were looking at this as an opportunity to get rid of problematic tenants and doing just that to increase rents, or that this could have been an opportunity to get rid of some problematic tenants. So it was just interesting takes how folks were approaching this crisis.
So Lyon, are you saying that Matt's brother is a problematic tenant?
Yeah, exactly. Come on. Take it No, it's at least on the mainland. They're not allowed to kick out tenants for 3 months. Is it the same in Hawaii?
Yes, it's similar. I don't think it's 3 months at the moment, though.
Okay.
But we do have, you can't evict, I think, at least until the end of May. Is that correct?
I was on a call earlier this morning in discussion about what property managers are seeing out there as far as the residential side. And I was told that renters are being real savvy, asking for rent reductions, negotiating hard off the gate regarding rental rates. And this is all apartment stuff, residential, which kind of leads into the multifamily debacle that we probably are going to see happen pretty soon. Ted, what are you seeing, Ted?
I don't really see a debacle in the offing. People are always going to need a place to live. The question is whether or not they can pay their rent, and next week's going to be very interesting in that regard. As far as transactional volume, the only buyers who are out there are looking for something that looks like a deal compared to last year. And the sellers are definitely not at that point.
Yeah. So
I don't see much volume right now. By the way, that what I was referring to earlier was in California, AB 828. That would allow, when you go to court to evict somebody, that would allow the court to make you keep them and lower their rent by up to 25%. I don't know if there's any chance of that passing, but that would obviously be devastating. And you don't have to prove that you were hurt by the virus or anything. The court can just.
We have a question, since we're talking about rents and not paying them and what's going on in landlords. Jan Kael asked, what if an owner closes the building in the parking garage and you're a tenant in his building? What's your obligation to pay rent to that owner under those circumstances? I believe that's how that question comes. Anyone want to jump on that? We don't have anyone really in management here, so it's going to come from our view. But anyone have anything to say on that? All right.
In retail, it's still to be determined.
Okay, still to be determined. We don't know.
There are some ongoing battles, let's say, with respect to that.
So it's like force majeure. It's just one of those acts of God you got to work out later.
Right.
All right.
Hey, sorry, quick question, Mark. Roger, I was reading an article and you were talking about loss of retail. The article had stated something on my order of magnitude of, for every 1 square foot loss of retail could equate to 2.5 to 3.5 square feet of additional industrial or distribution. I don't know what you guys see in terms of that. It's panning out to be where industrial is going to probably come out the winner in this whole thing, but to that degree, that's going to be pretty seismic.
I have my first thought is that in Hawaii, retailers utilize warehousing less than a typical mainland market, and that's mostly due to pricing. And if you want to see that, just drive behind a Walmart and you'll see 15 containers parked around the back. That's warehousing. And maybe with a reduction in locations, you'll see more on-site storage. Jay, what do you think?
Yeah, it would be interesting to see if these repurposed buildings start coming to light. I know when you start talking about e-commerce and last mile, everybody's looking for that busted Sears project that they can use as distribution in the urban core. So you started to see that on the mainland. How it'll impact Hawaii, be interesting to see, but I'd be devastated if the department store disappeared. I grew up at the mall. My mom worked at the mall when I was a child growing up, so I window shopped my entire life and I enjoy it. It's fun. So for me to believe that Macy's or Nordstrom's or Neiman is not going to be around, I'm completely devastated by that. Like, it actually hits home for me. Don't tell my wife that. She thinks I'm crazy, but that's
you know, in Hawaii,
the
department stores going away for rural America and probably the hardest hit malls, repurposing those malls is going to be very difficult. But I think if you told Ala Moana right now, and this is purely my opinion, that Macy's was going to leave tomorrow, they'd say fine, and they're going to build a condo there.
Yeah. And
I think the other malls in this state, certainly on Oahu, if the department store goes away, the repurpose is going to be residential because we had that type of demand typically in the past.
I want to lob one question to Lyon, and this is based on a discussion we had the other morning. So you guys underwrite a lot of apartment buildings, right? Different commercial assets and whatnot. What are you guys starting to see show up, or if there is anything showing up right now? Just curious.
Well, the process has been with every deal right now, it's a case-by-case scenario, and we are, we're taking in the appraisers and our vendors are taking in all this information in reams that's coming across their desk on a daily basis with market conditions changing by the hour, and trying to say, how does this affect the value of the property or the cash flow that the property can throw off? And what we're doing is we're getting down to tenant by tenant analysis in a lot of cases. For example, we just finished up a multifamily building in Kaneohe, and by and large, all the market participants that were surveyed said, yeah, again, remember everyone, the premise of the appraisal for a bank loan that's FIREA compliant is that it's the as-is value as of the day that the appraiser is standing on the property. So it's what's happening in the market as of that moment. Well, as of that moment, a lot of buyers, a lot of owners were saying, absolutely, if I had to buy something in today's climate, I would expect some discount. However, this one subject property we were working on, all the tenants were military based and had no interruption in their ability to pay their rent. And that was discussed within the appraisal, and adjustments to the cash flow were made accordingly. Whereas, if your other property where you have 1/3 or a half or 3/4 of your rent roll is seeking relief, it may change, obviously, the outcome of that assignment. So for all of the stuff that we're working on currently, it's just taking it another step further than we normally would have pre-COVID, where we're looking at, okay, what's the tenant rent roll actually doing? And if we're looking at multi-tenant retail, we're saying, okay, what is the mixture of essential and non-essential businesses? Who's open, who's closed, what's happening? And that's all filtering through the appraisal to try and project, the best picture we can at the moment, knowing that tomorrow could be a completely different news story.
Scott,
You got anything
Scott,
to add on that one?
Scott, you have anything to add? Because you sent some nice notes over on some of those exact subjects. I like some of the things you said, if you roll into that.
Oh, yeah, so we look at every assignment like Lyon does. It's a boutique now, but the federal law requires us to get the property appraised as is, as it physically and legally exists as of a current date. And so one thing that I'd like to mention is that dates are very, very important. An appraisal on the Twin Towers on September 10th, the useful life of that appraisal was 24 hours. So we're constantly having to look at how we're scoping the assignment. And what I'd like to say is that at no other time that I can recall in my 36 years of doing this is it more important for the appraiser not to just be looking at, the most recent executed agreements in terms of sales and leases, but to broadly go out and survey the market participants, the brokers, the leasing agents, the property managers, developers, investors, bankers, their peers. And I would strongly encourage, if you're in the brokerage community, to return any emails or calls from your friendly commercial appraiser, because if you don't, they're getting only the other side of the story, which is the challenges, the abatements, the concessions, the yes, everybody's talking about a V recovery because of the low interest rates. Well, go out and try to get a loan right now. Rates might be low, but the challenges getting it through credit approval at this point in time are, I would say, prior to March 11th, much more difficult at this point in time. Deals are not impossible, but there are challenges, and sponsorship is being looked at. I think the competitive pressures that existed over the past 5 years for interest-only loans, people trying to get non-recourse, I think all of those are somewhat right now negotiation points. So banks are looking at the strengths of the sponsorship, the equity in the deal, the strengths of the tenants much more closely. They are looking at, it's been said by my appraisers that we're pretty difficult to get assignments through, and I think Mark can probably speak to that as well. But it's more difficult. It's more difficult to get a deal through our credit approvers than it is through our appraisal department at this point in time, because they're looking at the global picture, and banks do not like uncertainty. Anyhow, I hope that helps out a little bit there, Mark.
And you are thorough and professional. We just have to give you all the stuff you want, and we make our deals. I've never not made a deal you were involved with, by the way.
No, absolutely.
You just made me work.
And I think you'll find for the most part,
there's the issue.
Yeah, we're able to find ways to do deals more often than not, but it is more of a challenge. And one thing I was going to ask Mark, I was going to redirect a question here. Roger had chatted about retailing being challenging prior to COVID-19 and the proclamation of the pandemic. Sean, we noticed that the occupancy on CBD office dipped below 10%, the vacancy. How do you see long term? I noticed that UHERO was looking at 14% maybe loss of office related jobs. And I saw maybe a couple hundred basis point loss in occupancy. But my concern is now with all of the movement towards collaborative space and the ability to efficiently transfer viruses from employee to employee, how do you look at, just as in retailing, e-tailing has impacted the bricks and mortars, half of our tower is now working out of our house. How do you see this impacting the market, at least in Honolulu?
So I sit on a group for kind of office space across the nation, and it's very segmented in how fast that's going to happen. Long and short of it is, it may be a wash because of the fact that I didn't even realize this. The tenancy that's going to be lost could be upwards of, when we were talking about this yesterday on the call, could be upwards of about 8 to 10% loss of office space. But with that said, the tenants that are healthy and wanting to still be operational are also going to need more space because they want to abide by some of these distancing rules. So office may actually become more generous, because at one point we were down to averaging about 150 square feet per person, whereas 10 years ago we were up at about 220 per square foot per person. So it shrunk, and then now I think that ratio is still going to start increasing, but at the same time, we are going to start losing some office users and office space. So we haven't quite fleshed it out yet, but what we're seeing right now in some of the major markets is that those who are reacting fast it's a wash.
Very good. Yeah, but there's some offsetting factors that, and this is why I say it's important to speak with your commercial real estate appraisers. If they only hear that there's a loss because of the decline in employment, they're not going to hear the other side of that story, which social distancing will create demand for greater space per employee. So it's things like that enter into the appraisal. We have no data stream right now. It's like trying to catch a falling knife. So appraising in the absence of market pricing mechanisms and data, it's very important that we act collaboratively in the professional community to achieve the most credible results possible.
Hey, Mark.
Is Roger still? Roger, I had a question for you.
Okay.
The same corollary with regard to the office that Sean just brought up. How about restaurants? It seems to me that for every chef, when I was leasing those, for every chef that went out of business and left a restaurant, there was 3 that wanted to rent it and start a new one. So we may be losing a lot of the, last 20% of the restaurants that came in, but aren't there a young group coming up that could fill those pukas? Would that offset it?
I think there will always be restaurant concepts and chefs and entrepreneurs that think that they can present restaurants in a unique way. Really, the question is, what will be the format of a restaurant? Again,
how are we going to set the spacing?
Will they become larger? Will the consumer, as a result, have to pay more for their food, for the experience? Maybe you're providing maybe it's a different experience completely. Maybe it's much more segregated, which might not be a bad thing, right? But maybe you're paying more for it. And I think the concern with the restaurant industry right now is that we're going to lose the good ones, the ones that we like to go to, the locals. And how do we save them? They've been lucky to stay open and offer takeout. And you can see, you can go to some restaurants now and get food, and they'll also give you cocktails to go. Like not without the ice, like you go home and you pour it over ice and so you can still have your favorite cocktail and your food from 12th Avenue Grill, right? In your own house. I think that everyone is learning to adapt to these shelter in place. And, but I think people are dying to get out. So whatever the next generation or the re-images, the restaurant will survive and thrive, I believe.
Well, not everyone can cook.
Yeah, exactly. I had a real-time story about financing, if I could. I heard this from the market. This was about 3 months ago, and 3 weeks ago, excuse me, 3 months. A nonprofit was buying a piece of property, and they were using their endowment as collateral. And the stock market dropped 25% in 2 days. And all of a sudden they didn't qualify and the deal fell apart. So when have you ever seen that? When would you ever have seen a lender when that would happen? So that's a real-time story and a deal tragedy that came directly out of this situation.
Do you find that your bank's looking more at the capital stack?
Well, first, I have to talk about what a capital stack is. You can't do that to us. Just give us what the capital stack.
Mark, this was an inside joke between Lyon and I, but
okay. Sorry.
Actually, no. Roger's absolutely he's absolutely correct. Equities evaporated. Market went from 29,000 to 18,000, and deals have fallen out, and we're not quite as busy as we were because of that. So, but Lyon, you were speaking the other day about proposed retailing and the challenges of, we've been talking about existing properties. The nightmare for the appraisal departments at this point are deals that had been construction loans that are going to be turning into evergreen land loans because they're proposed retail.
Yeah, it's definitely difficult. We're trying to find creative ways to continue to move forward, but with any we have proposed Bill 7 in the pipeline. For those of you who don't know what that is, it's proposed affordable housing. And we have proposed retail in our pipeline, all with challenges, and we're trying to move forward. Unfortunately, the difficulty with everybody involved in this phone call is that we don't have any clear end point in sight at the moment. And it's hard to forecast when you don't know. And we can't afford to take a leap of faith saying, well, it might be better in 18 months without a clear
As you mentioned construction loans. Tony, you sent me some notes earlier, and you mentioned a phrase that I hadn't seen before. You said construction loans, that's what keyed me to this segment, and I have no idea if it really connects, requires a loss of priority approval. I'm not familiar with a loss of priority approval. Notwithstanding there's no commencement or works of improvements, parties need a lot of additional time. What was that about, and what do we need to know with regard to closing construction loans?
As it relates to construction loans, I think in years past, the title insurers have had claims presented, and basically the court overview apparently gave the position that if the deal didn't make sense from the get-go, we're not going to, the courts are not going to offer any remedies for the title insurer or other parties affected by the mechanics lien. So with that in mind, basically our underwriters here locally or nationally have basically said even if we don't have exposure to any mechanics lien claims as of the date of insurance, they require an overview of the entire loan and an approval is required to be given before we can insure construction loans.
Chris, you haven't
Sure.
said much. You want to just jump on any subject and give us your genius?
Well, first of all, with regard to the capital stack, that's not just an inside joke between Scott and Lyon. That's an inside joke with every single commercial appraiser who's ever done an appraisal for Bank of Hawaii. So that we could probably have a whole conversation on Rodieisms with regard to that. One thing that's
I'm turning red, Chris.
yes,
Thank you.
exactly right. Was that a finger? Okay. The
Good Lord, you guys.
That
okay.
wasn't a finger, Chris.
Okay, all right.
Oh, no.
One thing that is interesting for us is the idea that dates matter, right? And they matter in two ways that might be interesting. One is, yes, indeed, we are valuing the property as of a specific date. Another nuance that's interesting only to appraisal geeks is the idea that the term market value, which is what we are providing to the banks, market value assumes a sale as of the date of value, but it also assumes an exposure time prior to the date of value. So in the early part of this, what that means is if you think that the property would have sold at some time in the past 12 months at this price, there's an argument that could meet the definition of market value. But that's not what the banks are really asking for. The banks are asking for, what will this property sell for today if we were to foreclose on it today? And that's an interesting question when you have no data, especially when we're talking to brokers and saying, how much would you have to discount this property for it to sell today? And all the brokers are saying, well, I would never advise a client to sell it for that today, because you'd be way wiser to wait 90 days or to wait 6 months or whatever it is. And even though this has been an unbelievably drastic downturn, I've talked to a bunch of the people on this panel about how we're currently appraising a hotel that went from 95% occupancy in mid-March to 0% occupancy on April 1st. And it's an unbelievable occupancy chart to look at that I've told my associates that you'll just never see this again in your life, hopefully. But the idea is that we've got to provide an estimate of value. And so on one hand, I think that story needs to be told that right now it might be a case of just no activity happening. But what we're looking at, and we specialize in industrial, so what we keep hearing is that industrial's holding value pretty well right now. There's some cases,
It is.
but one thing we start to look for, that we used to look for in the last downturn, is listing prices and asking prices. And right now it's too early to see. Well, how do I mean that? In up markets, you don't really use a listing as a comp. Because brokers are free to ask whatever they want for a property, and if it hasn't sold, it's not a comp. Same thing with an asking rent. But in a down market, listings become kind of interesting, because if you've got comps from 4 weeks ago, or you've got comps from 5 weeks ago, and the property next door is available for sale for a cheaper price than that comp, well, that comp probably isn't very good anymore, and the lower asking price of the one next door, even though it hasn't closed, is probably your best comp. And so I think it's important that when we say there's no data, there really is data that starts to come online. And we're only 5 weeks into this, but I would imagine as the pain starts to hit and as PPP starts to wear off, that in the next 4, 6, 8, 12 weeks, we're going to start seeing people really get desperate, and they're going to really need the money. So asking prices are going to drop.
Oh, blank spot.
Blank spot. What else? Okay.
Ted, multifamily.
Yeah.
Multifamily.
I actually have one thing that was kind of I was interested with.
Sorry, Ted. We'll get back to you.
What Roger was saying. Roger, when you're talking about the small restaurant guys, being more mobile or flexible, or being able to bend, and this is probably on the same analytical level of Matt's brother's apartment, being a comp. But I eat out, takeout food, obviously, if you look at me, almost every meal, and I've started to see a transition amongst the restaurants that I go to, or the takeout restaurants, where I would say more than 50% of the small ones have transitioned to either giving a discount for cash or just flat out not taking credit cards at all. And of course, my thoughts are, obviously, hey, when the going gets tough, the tough got to start scrambling. And so they're probably trying to underreport their taxes, underreport their GET. And I'm wondering if they're using that as a weapon to seek rent abatements from landlords. I just don't know if you've seen any of that.
I think it's too early to tell on the rent abatements, but I think it's interesting how, you go in and you get takeout and it's $20. They make it very easy for the cash transaction. I haven't seen any that won't allow credit cards. I think it's too early to tell. I mean, people are trying to figure out, we're still trying to figure out April rent. And I think, like maybe Scott said, next week, guess what? We got a whole nother month that's due. But I do know that for the smaller retailers, it's all about cash management. I mean, I know a couple where, they have a controller or a CFO who signed all the checks. It's the owner. The owner signs every single check now. They oversee everything. So cash is king is more than ever.
Hey, Chris, to your point.
Sorry.
Oh, sorry. To your point, Chris, what we're seeing in the office sector is landlords asking for financials. And this is a perspective that I really didn't catch on to, which is interesting. We always presume that their landlords are going to want to see hardship, and always financials are always rear facing. So these tenants are saying, well, I can't show hardship yet, but it is coming because of the lack of revenue. But what's happening is these landlords are actually not wanting to necessarily see hardship, but they want to see how strong the tenant is to be able to assess if they're going to give abatement or if they're going to give concessions. If the tenant's already hanging on prior to COVID on a very weak balance sheet, the landlords most likely aren't going to give them other additional concessions to just I guess lengthen the bleeding process. And so it's a little bit of a reverse psychology from what tenants are expecting and wanting to say, oh, well, I can't show financials that are showing hardship. Well, you know what? Landlords want to see that you're strong. And then if you are strong, that they may put other monies towards helping you to be successful in the long run.
Enter Darwin. Survival of the fittest.
Hey, Roger,
coming back.
Roger, I had
no more fair.
I had a quick question for Roger. Having gone through like this, I think is my 5th cycle now. Typically retailers retail property owners after a shock event start putting in percentage rents, even though they know they're not going to capture any percentage rent, strictly for the purposes of getting financial data from their tenants so they know how they're doing. Do you think there's going to be a push in that direction going forward?
There probably will be a push. I can tell you from the national retailers over the last 10 years, it's been to get rid of percentage rent, and they just want to quantify their lease terms up front. They don't want anything beyond that. They're only going to approve those numbers. So it's become a bigger battle. And
that's interesting.
To Sean's point on the reporting of financials, that's one of the bigger grinds that's happening right now is landlords want to see financials, tenants don't want to show them financials.
Yeah, that's why I was wondering because the only way you can get it contractually is if you have the ability to get it contractually through like a percentage clause, even though you're never going to capture it. If your base rate is established at market, but you're asking for percentage, it's just a clause that helps you capture that information.
And to Sean's point, I was going to chime in with you, Sean. I agree with what you said, but what's the worst thing for a landlord? Vacancy, right? One of the worst things, vacancy. Sure. Would you rather have that guy limp along and retain tenancy, or go vacant. I mean, there's some very, very hard decisions coming down the road in retail.
Thank you.
I had a question for Matt. If you could just give us, from your position on the mainland, so to speak, we usually lag behind, but what are some of the high points that you see in the next quarter? What's going to happen?
Yeah, I could just speak to lending. I mean, what does my crystal ball say for the next quarter? I can tell you what's happening right now. Let's say we have about 36 deals, loan deals moving forward in different stages right now. I'd say where it took 30 to 45 days to close a deal prior, it's now taking 60, 90, 120 days to close. And I only expect that to get, I would say my crystal ball says the next quarter is going to be worse and slower. I will say a lot of that is because of PPP loans. A lot of banks are focused on that and trying to save small businesses and give them their money. So maybe when that's all dried up and applications are done and everyone's approved and got their money, it does alleviate a bit, but there's still a concern of where values are. So, will they still be cautious? Will appraisal values come in? Will they still be giving 70, 75% LTV? What bank's going to take the first jump? So I think next quarter, things are just going to move a lot slower, a lot less transactions, a lot more. If transactions are going through, they're going to be a lot more conservative. Rates are going to be great. You'll just see lower leverage loans. You won't see as many of the bigger banks doing deals, I think. They have the balance sheet to weather the storms. I think you're going to see secondary market banks try to eat up market share at some pretty aggressive terms. So if you have any clients, I advise them to go to secondary market banks. I just see things moving slower.
On the multifamily valuations, I see a lot of buyers out there who are happy to buy at 10% or more off of last year's market value, but not a lot who are out there to buy at last year's market value. And the more difficult lending standards, that's going to cut into the buyer pool even more. Another factor on those, on the lending standards, that's going to significantly affect the refi market as well. A lot of people like to refi their properties as rates have gone down.
Yeah, I think one of the bigger groups that's going to be hit is, I don't know if this is the same in Hawaii as it is on the mainland, but there's a lot of syndication deals that were done in the multifamily market over the last 12 to 24 months. So you get a general partnership of 4 sponsors who would bring 10 to 20% of the equity, and then they get LPs, which could be 20, 30 small limited partners to go purchase a 120 unit, $20 million building, right? I'd say 99% of the time, those were levered with agency loans or some kind of secondary market loan at 75% leverage. And most of them, they're value add plays where they want to refinance and pay off the limited partners so then the partnership can own the property outright, right? Are they going to be able to refinance those properties when they were at 75% LTV if values drop? That's going to be a big concern that I'm watching closely.
I think Matthew's right. As you start seeing the underwriting standards focus on more strict adherence to debt coverage ratios and debt yields that have been relaxed over the past 5 to 6 years because of the competitive market, we're once again focused on debt coverage ratios at maybe indexing up the interest rate slightly, and we're looking at strict adherence to debt yields where 4 or 5 years ago, you started seeing those standards getting relaxed quite a bit, where you'd have borrowers being able to get higher loan to values than perhaps the income supported.
I'm hearing too that banks are kind of stress testing them, and using a debt coverage ratio with reduced income.
Yeah, absolutely.
I can give you real-time data. I mean, let's say 4 months ago for multifamily property, you would need a 1.15 or 1.2 debt coverage ratio. They're now needing 1.25 or 1.3, right? 3 months ago, you would be using whatever the market vacancy was, which could be 3 or 4% in California for multifamily. They're now stressing it at, like you're saying, Ted, they're stressing it at 8 to 12%. just to forecast if tenants aren't paying rent or if tenants are eventually evicted because they aren't paying rent, right? Management expenses are both going up. LTV constraints are being pushed down from where they would go 75, they go 65% now. So yeah, there's just a lot of underwriting criteria that, or guidelines that are being changed.
Okay, so we are almost at 12 o'clock and the recording of the video got started a little bit late. So I wanted to go around to the panel speakers and have you introduce yourselves too again. So we're gonna start again with Mark Ambard.
Hi, I'm Mark Ambard, CCIM, owner of Ambard and Company Commercial Real Estate. I've been the moderator of this incredibly interesting group of people.
Awesome. Jay Elicker.
I'm Jay Elicker, Commercial Asset Advisors. I'm an industrial broker. Been in the business 16 years.
Awesome. Roger Lyons.
Don't forget Sean. Roger Lyons, I'm a partner at the Beall Corporation. I've been working in the shopping center industry for 32 years.
Awesome. Sean Tadaki.
Sean Tadaki, managing partner for Commercial Asset Advisors, specializing in office, healthcare, and institutional investments.
Okay. Ted Miller.
Ted Miller, Prime Pacific Properties, multifamily broker in California and Hawaii since 1997.
Tony Ching.
Tony Ching with Fidelity National Title Insurance. I'm an advisory title officer, have been in the business for over 50 years, and primarily focusing on the larger commercial transactions.
Okay. Matt Bucaro.
Matt Bucaro, Tauro Capital Advisors, commercial real estate loan broker in the mainland. Been doing it for about 8 years, specializing in multifamily and retail.
Scott Rodie.
Scott Rodie, Chief Appraiser for the Bank of Hawaii.
Lyon Dupre.
I'm Lyon Dupre. I'm the Commercial Appraisal Manager for American Savings Bank.
Chris Ponsar.
Chris Ponsar, the manager of Ponsar Valuation. And for everyone who's been texting that saying that I should turn the logo towards the camera, this is actually a blank one.
All right, everybody, I'm Olivia Morikawa from Fidelity. Thank you for joining us and stay tuned for next week. We're gonna have an all residential panel. Okay, take care.
Thank you, everyone.
Thank you.
Thank you.
Bye.
Thank you all. Thanks, everyone.
Awesome. Thank you.